Hey, howdy, friends. It's Steve DePoe here with the Rose Realty team with this week's Real Estate Vlog for North Texas. Today, why buy now? So either you're in your apartment, you're comfortable, you're kind of hanging out, or you're in a house. For the last couple of years, you've been thinking, oh, we ought to upsize or downsize or something along those lines, or move to a better part of the metroplex, or less crowded, or whatever you want. And why should I buy now? Why should you buy now? Well, I'm going to give you a couple of little factoids that'll help you out. So the rates are high. Let's talk about the dead moose on the table. Okay, rates are high right now. They're around 7.8, 7.9%. They haven't been this high in like 2 decades. Okay, so it's really pretty astounding. So what does that mean to you? That means that if you want to buy, then either you have to come up with more money as a down payment, or you accept not quite as big a house or nice a house. Okay. If you're selling, then what that means is twofold for you. So when you sell your house and you want to go someplace else, you're going to have a bigger mortgage payment. Excuse me, your rate's going to be bigger. Your mortgage payment may be lower because of the equity we have built in. We'll talk about that in a minute. Also, the problem with a seller is that that there are fewer buyers right now than there were, let's say, 18 months, 2 years ago. Okay. So the rates are kind of keeping people on the sidelines a little bit. So the higher mortgage rates, how do they impact you? Well, so with the new purchasers, that's an increased cost, increased money, increased mortgage payment, maybe increased amount to put down. People are taking money out of their 401ks and retirements and stuff to put down on some of the the down payments. And if you're a seller, if you're an existing homeowner, you've really got no real big juicy incentive to move, because hey, you got a nice comfortable rate, you got all this equity, you're gonna stay on the sidelines. Before we keep on going, hey, please subscribe to our YouTube channel. Go to youtube.com, search for Moving to Dallas, as you see it right there. That'll help us get more visibility on YouTube, more people to see these videos, and that'll really help us out a lot. We really appreciate it. We appreciate you. Thanks. So where were we? So where are the rates going to go from here? Well, so there's kind of two things that we know about and we've been reading, right? The first is the Fed has said that the economy is heating up, and that might require interest rates hikes because they hate inflation. Okay, I mean, inflation back was it this summer or last summer was something like 10% or something like that. So inflation is just another tax. Okay, and so the Fed has said that they want to potentially increase rates in order to slow down the economy. Okay, that means that you won't go out and buy stuff on credit specifically, and that it'll be harder for businesses to get loans, and the loans they do get will cost them more and that kind of stuff. But what they don't realize, I think, at the same time, is when they increase the rates like that, it takes people out of the market, out of all markets, takes people out of the real estate market. People aren't going to buy cars, and then that potentially sets us off into a recession or stagflation, something like that. However, the other thing that could happen is we got an election next year, right? And no sitting president wants to go into election with high inflation, stagflation, recession on the horizon, that kind of stuff. So there is a possibility that they'll relax rates within the next 3 to 4 months in order to get the economy, kind of going on again, like it was back in 2018, 2019, before COVID hit. And so they may reduce rates in order to get that chugging along. So unfortunately, right now it's sort of like chasing your tail, because this Chase Schiller survey came out it's a U.S. national price index came out and said that the prices of houses are actually inching up again. Okay, so the prices of houses are inching up, and now the cost to buy those houses is now higher. And so, what are you going to do? So the people, so I really feel for the people like the first time home buyers. I mean, oh my goodness, they're sitting on the sidelines, they're waiting, they don't know what's going on. They don't necessarily have, have, a whole bucket load of money that I can say, okay, so let me put down another 50 grand to keep my payment lower. They don't have that, and so they're the ones that are suffering the most. Everybody else, yes, everybody else is still suffering too, because I can't buy or sell based upon what they want to do, because there's not enough things to buy. I don't want to sell because my rate will go up, and it's a vicious cycle that the government has got us into. And then again, it's like chasing your tail. So what do you do? I mean, here's a couple of smart things to start doing. Yeah, you have to get in. Basically, you have to get into the market. Okay, you're not going to start to build wealth for you and your family, and you're not going to start to build equity in a house unless you have a house. Okay, now, so maybe that means that you're looking at spending, let's say $300,000. Okay, maybe you're looking to spend $300,000. And that's great. That's a great number. But maybe the house isn't as big as you want it, or have the yard that you want, or have as many guest rooms or bedrooms as you want, or something along those lines, right? Do it. Go. If it's a house that can fit into your budget, okay, and maybe stretch a little. But if it's a house that can fit into your budget and can keep you and your family happy and protected, and it's in a good location, I say go for it. Okay, and this is why. Because as soon as you get into that house and you start saying, okay, well, this isn't quite as like the way I wanted to, and I wanted a bigger backyard, but we got a backyard, but we got shrubs back there, and I wanted it fenced in, so I went off to fence it in. As soon as you start putting sweat equity into that house, the value of that house goes up. Okay, number one, and that the equity you have built up in that house continues to go up. Okay, so what does that mean? That means in 2 or 3 years, okay, when you buy that house, after you bought that house, and the value of that house goes up, and you have equity built up in that house, okay, then you can parlay that equity that you have built up and buy another house. Maybe when rates are down a little bit, and there are more houses on the market, then you can go out and you can do another deal. Maybe you keep that house there as an income producing property, and you rent it out. There you go. But now you have the equity built up, and you can take that equity and it can work for you. Right now, you want to know right now. Right now, you're just paying somebody else's mortgage. You're paying your landlord, and you're giving them a check every month, probably for the same amount that your mortgage would be, okay? But that rent check isn't tax deductible. Where if you went and bought a house, then potentially your HOA and your taxes and the interest you pay on your mortgage, that's all tax deductible, okay? And that's all working for you, and that's all good stuff, okay? So what can you do? What can you do right now, okay? So you're going to wait now, let's say until January. What can you do right now? Make sure you have excellent credit. Work on your credit. If you need help working on your credit, I'd call my lender and say, Mr. Lender, I need help with my credit. I need to improve my credit. What do you suggest? And maybe, you know what some people do? Some people take out a personal loan. Doesn't matter the interest rate. You take out a personal loan and you pay it back in 6 weeks, okay? That's a good, nice big gold star on your credit report, and then your credit's going to start to go up. Have you saved for a down payment? Put yourself on a budget, baby. Put yourself on a budget. Stick with that budget, okay, and don't deviate from it. What do they say? Pay yourself first, okay? So take money, take money as soon as you get your paycheck every other week or every week, and take that $100 or whatever the amount is, and stick it in the bank, and don't touch it. And it doesn't matter what happens, stick it in the bank and build up that nest egg, so that you have money for the down payment. And then the other question is, are you planning on staying in the house for a while? Well, the answer should be yes. Okay. So if you can make it through, if you can make it through the first couple of years, and your lender gives you the mortgage, and you make it through the first couple of years, you're set. You're set, man. Okay. And then you just keep on plowing forward. Your equity keeps on building up. Okay. Now, if you plan on flipping it in a year, then it's not going to work out. Okay. But keep on marching forward and making sure that you put that money away, and you're building your credit score, and that you plan on buying a house and staying in it for a while. So two things to remember, and I just kind of mentioned it. Okay, if you're a renter, your interest rate is 100%. Your interest rate is 100%. You're taking your rent check and you're sending it to somebody, or just dropping it in the slot, down there on room 100 or whatever it is, and you're paying your landlord, and your interest rate on your apartment is 100%. Okay, so that's number one. You're paying your landlord, or you're paying your landlord's mortgage instead of paying yours. Okay, so your landlord is sitting there twiddling his thumbs, just raking it in, because other people are paying his mortgage. And I don't care whether it's a individual person or a corporation. They're just raking it in, and they're just sitting there fat, dumb, and happy. Okay, while you're paying his mortgage, and you can't hang a picture on the wall, and you can't paint the bathroom because it's not your place. Okay, it's not your house. Now, on the other hand, if you're an owner and have a significant amount of equity built up in your house over the last 4 years, you've got a nice pile of equity there. Okay, what do you do with that equity? Well, you can do a couple of things, right? You can, number one, you can take that equity, you can get a home equity loan, and you can take money out of the house and you can buy a rental property, or you can sell your house, take that equity that you have built up, and plop all of that down on the new house. Now, sure, your interest rates are going to be higher, but you're going to you potentially have a bigger house with, potentially, depending on the equity, you could have a same mortgage payment because you plop down a lot more. But it's all figures. It all comes out in the numbers. We'll have to figure that out, right? But you got a lot of equity built up in your house over the last 4 or 5 years, especially the last 4 or 5 years, and you can take that equity and make it work for you and your family. Building wealth and building equity in your house. So I hope that kind of got you thinking a little bit. I feel for people who say, yeah, the interest rates are so high. Hey, look, truth be known, everything that I've read, when the interest rates started going up about a year and a half ago, everything that I've read said that we are not expecting in this country for interest rates ever to go below like 5% again. Okay, so think about that. If they're almost 8 right now, we're expecting interest rates to slide back down, maybe to 6, maybe to 5.5, but we're never expecting them ever to go to like the 2s and 3s again. Okay, that was like an anomaly that was going on. Next week, Code of Ethics and what's going on in real estate today. I always like to do a Code of Ethics vlog maybe once a year, and this is that case, especially because there's some interesting stuff going on out there right now in the world, and I wanted to kind of chat about that. This is Steve. I'm with the Rose Realty team. I'm gone.